Hello everyone, welcome to the Fintech podcast by Introact. I'm Nick Thompson. Back in March, several banks failed for what was called illiquidity and deposit flight. Signature, Silicon Valley Bank, and First Republic were liquidated by the FDIC. To stem the tide, the Fed produced a new banking program called the Bank Term Funding Program, or BTFP. For those unfamiliar with the program, this allowed for certain banks to get loans from the Fed for up to a 1-year duration. What's different about this program than the discount window or repo is that the loans were based on the par value of their bonds and not the market value of their bonds. This helped the banks avoid having to liquidate their bonds at a loss if the banks faced any kind of liquidity needs. This may help them avert any potential crisis. It also increased their costs of funding. The interest on the bonds will not cover the interest charged by the Fed, and this will hurt potential earnings. So the banks are faced with treasury portfolio losses and higher costs if they use the BTFP program. In addition, there's fierce competition for their deposits. Both institutions offering money market rates and U.S. government bonds are yielding hundreds of basis points higher than the banks can afford to pay their depositors. This has led to deposit flight for banks. On top of that, commercial real estate, or CRE, has been in the news with the persistent remote work, which exacerbates the pressures on commercial real estate values. According to research by Stanford economist Nicholas Bloom, prior to the pandemic, remote work represented 5% of the U.S. workforce. Currently, it stands at 30% of employers are staying home. This is a 6-fold increase from just a few years ago before the pandemic. In a recent article on Zero Hedge, they posted the chart that's on the second half of this screen, showing the commercial real estate vacancy rates in several major U.S. cities. What's clear from the data is that the COVID pandemic clearly changed the habits of work in America. And in every city, the vacancies are increasing, even though the pandemic is clearly over. This speaks to a shift in corporate America that could be driving additional banking stress. The concerns about high vacancy and declining commercial real estate prices were addressed in the Federal Reserve's Financial Stability Report in May. They said, many contacts saw real estate as a possible trigger for systemic risk, particularly in the commercial sector, where respondents highlighted concerns over higher interest rates, valuations, and shifts in user demand. Some market participants associated risks in real estate with the emergence of the banking sector stress, noting exposure to underperforming commercial real estate assets could prompt instability. The Fed also pointed out in that same report, aggregate CRE prices measured in inflation-adjusted terms were declining. These prices are based on repeat sales, and many mask growing weakness as more distressed properties are generally less likely to trade. So here the Fed is saying that although the prices of transacted CRE are declining, the buildings that are not changing hands could be hiding even steeper declines. This may cause additional strain on the bank balance sheets, and this would be invisible to us right now. Clearly, the chart on the left shows prices starting to come off the recent peaks, and the report goes on to say while price declines were widespread across all property types, fundamentals in office sector with particular weakness in offices in the central business districts, with vacancy rates increasing further and rent growth declining since the November report. So along with high vacancy rates, additional pressures come from higher interest rates. Over the past year, the Fed has tightened its monetary policy, making borrowing costs more expensive. This means CRE loans nearing maturity or new buyers will have increased cost to refinancing. So we have pressure on price, pressure on interest rates, and pressure on vacancies. And next we have the response from the bank, which makes it even worse. Lending standards at many institutions have become even more stringent. As market situations deteriorate and property values decline, lenders become more conservative and tighten the lending requirements. This is evidenced by the Senior Loan Officer Opinion Survey performed by the Fed last month. It shows that 70% of banks have tightened their lending standards for CRE loans. This negatively impacts the supply of loans in the CRE market. With all the headwinds, we see problems on the horizon for the banking sector, specifically for small regional banks with high exposure to commercial real estate. And we're not alone. In a recent interview with Bloomberg Television, Jamie Dimon, CEO of JPMorgan Chase, speaking about possible new regulations and tougher standards, said, "I think it's going to be worse for banks, more regulation, more rules, and more requirements." He also stated that there are community banks that are telling him that they have more compliance people than loan officers. In another recent interview on Bloomberg Television as well, Ross Perot Jr., a real estate developer, said if the industry can't get construction loans, real estate will have a recession. The key to commercial real estate today will be banking. So when we turn to the stocks and the performance of the stocks, I'm looking now at the regional bank ETF put out by Invesco with the symbol KBWR. Technically, if in March we broke down from the long-standing support with the announcement of that Signature and Silicon Bank failure, after which we formed a multi-year low. Since the beginning of May, the market has rebounded about 25% off the low. In our opinion, this offers a great opportunity to reduce your long exposure to the sector. Additionally, for professionals, this offers an opportunity to re-enter short positions as the bounce loses its momentum. We recently released a report identifying several banks with high levels of commercial real estate exposure and assets between $10 and $50 billion. We believe this group will be most vulnerable. You can get the report by following the link below. If you haven't seen our work before, let me tell you a little bit about Interact. Interact is a capital markets matchmaker. We connect corporate issuers with compatible investors using AI-enhanced investor targeting, commissioned research to build a broad investor awareness, and dedicated salespeople that facilitate direct investor engagement. Interact specializes in progressive industries, which are defined as industries within every sector that attract the most new capital investment, and as such, usually experience the best growth. Within the financial sector, the progressive market is Fintech, which we define quite broadly. Fintech is changing the way money makes money, compressing key metrics of time and cost, while delivering superior customer experience and unlocking new markets through innovation. Fintech has been disrupting the financial services industry gradually over the last 25 years, first with plastic money revolution, then electronic money revolution, and now stand at the cusp of a digital money revolution, fueled by the combination of emerging technologies such as blockchain, AI, and cloud computing. This disruption has impacted all the verticals in the fintech service industry, which include payments, banking, lending, insurance, and wealth management, creating an enormous sector opportunity. My role here at Interact as the curator of the fintech is to be a thought leader, identify trends, opportunities, and risks in the markets, and most importantly, bring attractive investment opportunities to worthy investors. To that end, on May 2nd, we launched our FinTech Primer, where we discuss the industry growth projections and opportunity. In this 140-page report, we cover every aspect of the fintech industry, laying out our overall thesis on the opportunity. This podcast is dedicated to bringing you a monthly look into our research and the growing industry of fintech. Over the coming weeks, I will bring more actionable ideas as well as news and research on the industry. We hope you will subscribe and click the notification bell so you don't miss our videos. Thanks for joining us today. See you soon.